Okay, I've started sharing my screen now, and this is the question. So we'll just have a quick read through. It says the following information relates to Swiss traders, and then it gives you the balances on 31st December 2008. So now, the thing with the balances being on this day, the 31st of December 2008, it means that the same balances exist on the 1st of January 2009. So these balances are the same balances that also exist on the first day of the new year. Okay, so they told you land and buildings 150,000 rand. Equipment was 240,000 rand and accumulated depreciation was 72,000 rand. Then they went on further to say that the depreciation on equipment is provided at 15% per annum on the diminishing balance method. The equipment, which had a cost price of 80,000 rand on the 1st of January 2008, was sold for 74,000 rand cash on the 1st of November 2009. Okay, so it was from the question I wanted you guys to pick up that this point number 4 was not relevant towards the asset disposal because this talks about the new equipment. Okay, the new equipment which was bought on credit on 1st of January 2009 for 130,000 rand. This does not deal with the disposal of the asset. This rather deals with the purchase of a new asset. So the points here that were relevant was this point here which says depreciation on equipment is provided at 15% per annum on the diminishing balance method, and that equipment which had a cost price, so this point number 3 here, which talked about the sale of the equipment. Okay, so let's go further down. Okay, sorry, I didn't show you guys the year end. So the year end that this relates to was for the 31st of December 2009. Okay, so if we're dealing with this as the year end, I've spoken about the timeline before. So the first step that I've done here is I've drawn the timeline. Okay, so you can see my timeline starts on the 1st of January 2009. It ends on the 31st of December 2009. And there is a point here which I've drawn on the timeline, which is the 1st of November 2009. And this is here from the scenario. This 1st November 2009 was when the sale happened. So it happened 10 months into the financial year. Okay, the sale of the asset, that's when it happened. So if you look at the DCAST principles, if you think about the cost price and the selling price, right? So if we go back here, it's given to us here in point 3. It says equipment which had a cost price of 80,000 rand. So can you see that? That 80,000 rand, this 80,000 rand is given to us the cost price, and the selling price, which is 74,000 rand, is also given to us. Okay, so the 80,000 rand is the cost and the 74,000 rand is the selling price. So then it leaves us with then working out the depreciation, the accumulated depreciation, and the profit and loss on sale of the equipment. So I've written it down here. So the cost price on the 1st of January 2008, this is when the equipment was purchased, was 80,000 rand. The selling price of the equipment, it was sold on the 1st of November 2009, was 74,000 rand. Okay, so now this leaves us with the first step, which is then the depreciation. So if we go back to the question and see what method of depreciation they have used, it says here in point number 2, depreciation on equipment is provided at 15% per annum on the diminishing balance method. Okay, so remember with the cost method, it's a constant amount each year. We don't have to worry about the previous year's depreciation to work out the current year. But with this method here, the diminishing balance method, it's important to know what was the previous year's depreciation for us to work out the current year's depreciation. Okay, so because this equipment was purchased on the 1st of January 2008, and that means that the financial year would have then ended on the 31st of January 2008, that is 1 year's worth of depreciation. Okay, so it was owned 1 year prior to us selling it. So from the 1st of January 2008 to the 31st of December 2008. So we will work out the 2008 depreciation. Okay. So the 2008 depreciation, it was the 80,000 Rand. This 80,000 Rand was our cost price, what we initially purchased the equipment for, times the 15%, which is the rate of depreciation. Because it's 2008 was the first year that we've bought it, that we've bought the equipment, we don't have to worry about any previous year's depreciation because it's the first year it's in use, so there is no previous depreciation. So when we input this in our calculator, we then get 12,000 Rand. So this 12,000 Rand is the previous year's depreciation. So with this figure, this 12,000 Rand here is going to help us to work out our current year's depreciation. Remember, because this is the diminishing balance method. So what we do here is we take the cost in 2009. So the cost was 80,000 Rand. Okay. So we take the 80,000 Rand, which is the cost. We minus the 12,000 Rand. You see there's an arrow here. This 12,000 Rand came from the 2008 depreciation because of the diminishing balance method. You minus the 12,000 Rand, okay? You multiply it by the rate is 15%. And see this apportionment here is 10 over 12. So let's see how we've got 10 out of 12 months. So back to the question here. It says that it was sold for cash on 1st of November 2009. So if we go to our timeline, see, we're going to count from January until the 1st of November. So when you do this counting process, because it's the 1st of November, you see that? It's not the 31st of November. So you don't count November as being a month, okay? So you are going to count January, February, March, April, May, June, July, August, September, October. Okay, if you count them on your fingers from January to October, so it's January, February, March, April, May, June, July, August, September, October. We don't count November because of this date here. So it's as if we sold it on the 31st of October, okay, because of this date here. So it's essentially, it was in use in the business. It was only in use for the business for 10 months, okay. So from the 1st of January 2009 right up until here, the 1st of November 2009 is 10 months. So this 10-month period, so we apportion the depreciation here. Okay, that is why we use the 10 over 12. And then we've got 8,500. So our current year's depreciation is 8,500. Now we're going to go on to the accumulated depreciation, okay? So the accumulated depreciation, as I've said in the week 1 slides, is that it is all the previous depreciation added up. So it is going to be this 12,000 Rand here in the year for 2008, and it's going to be this 8,500 Rand here for the year of 2009. And so when you input that on your calculator, the 12,000 plus the 8,500 Rand, you're going to get 20,500. That is your accumulated depreciation. Is everyone understanding so far? Does anybody have any questions? Okay. So now we'll go to the last step, which is the profit or the loss. Okay. So the step to work out the profit or the loss was we have to find out the carrying value, and then we'll compare that with the selling price. So how do we work out the carrying value? The carrying value, remember, it was the cost price less the accumulated depreciation. So now let's go back to the question and see what our cost price was. Okay, we see here in point number 3, equipment which had, this is the cost price. The cost price is 80,000 Rand. Okay, what is the accumulated depreciation? We worked that out just now. The accumulated depreciation is 20,500. So our carrying value is going to be the 80,000 Rand cost less the 20,500 Rand accumulated depreciation. And we've got it here. When you input that in your calculator, you get 59,500. So on the date of sale, which was the date of sale was the 1st of November 2009, the carrying value of the equipment was 59,500. Okay, so now we need to see, did we make a profit or did we make a loss? So we go back to the question now. We need to see what was our selling price. So it was, the equipment was sold for 74,000 Rand. So let's go back. So let's think about it. So 74,000 Rand is what we've sold the equipment for, while it was actually worth 59,500. So we've actually sold the equipment for a higher price than what it is worth. So that is actually a profit, okay? Because we've sold it for more than what it's worth. So our profit is then the 74,000 Rand. Okay, what is the 74,000 Rand? The 74,000 Rand was the selling price, the price at which we sold the equipment for. The 59,500 is our carrying value. This is the amount that the equipment was worth on the day it was sold. And we've made a profit then of 14,500. Okay, so this is our profit. Is everybody understanding? Do they understand the concepts? Do they want me to go back and re-explain anything else? Did you guys understand everything? Okay, I saw your messages coming through. Just a quick announcement that this session is going to end at 1:30 on Zoom. So please join in with the new ID and link at 1:30. Okay, it might just randomly just end while we in the lesson. Okay. So now I'm going to show you guys the T account for asset disposal. So we're going to take all the figures that we've been working out for the past few weeks, and we're going to put them into a nice T account. Okay. So let us go back to the screen sharing. Okay. So remember, we've done the steps with DCASP, the thing I've been telling you now. It's called DCASP. And we've been working out all these figures. So what we've actually been working out these figures for is the T account, is for the T account called the asset disposal account. Okay, so let me show you guys what it is. Okay, so this is how it looks. Okay, remember we've been seeing DCASP. Okay, so I'm going to show you what each one is. So if you look here on the debit side, you've got here equipment for 80,000 Rand. Okay, and what this actually is the cost price of the equipment. Okay, remember they said on the 1st of January 2008 in the question, they have purchased this equipment for 80,000 Rand. So this 80,000 Rand here in this asset disposal account, this is the cost. This is the step C in DCAS. Okay. Then you look on this side here, the 20,000 Rand 500. Remember we've done the steps D and A. So D was the depreciation for the current year and A was the accumulated depreciation. So this 20,500 Rand, let me show you guys. So remember we worked it out just now. So this 20,500 Rand goes here on the credit side. The accumulated depreciation on the equipment, it's the 20,500. The 74,000 Rand here, this 74,000 Rand here. So what is this? This 74,000 Rand is the selling price. It is step S. Step S is the selling price. So this is how much we've received for the equipment. So you see here they've written bank in this details column. So I will send you guys other things you can possibly get here. So it depends whether someone has donated the assets, so you'll write donations here. If the owner has taken it out for his own use, and you'll write drawings here. So this details column changes. Okay, so how you get the balance for this account is you look at which side is greater. So this profit on sale of asset is not here usually. Okay, now because this account is already drawn up for us, so that's why it's here. But when you initially do it, when you initially draw up this account, this is the balancing figure. Okay, this asset disposal account is the balancing figure. Okay, so it's the balancing figure. Why? Because we're going to see which side is greater. So if you look at this account without the profit on sale of asset being there, the credit side is greater. So if you see this, 20,500 plus 74,000 Rand is 94,500. Whereas if you look at this without the profit on sale of asset, the 80,000 Rand is less than the 94,500. So the debit side has the balancing figure. This balancing figure is the profit on sale of asset. So if our balancing figure is on the left side, it's a profit on sale of asset. If the balancing figure is on the right side, it is a loss on sale of the asset. Okay? Does everyone understand this account? I will send you something to do maybe by the end of tomorrow, so you'll be able to do this account on your own and then see how it actually works. Is everyone understanding?